Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad to be back. Actually, we've not been on for about a month now, so it's kind of good to get back in here. We try to do a show here live where we can try to help people with their finances, specifically, dealing with retirement, how to manage your money, what to do with taxes during retirement, and, essentially, how to plan for retirement in total. And so we're willing to answer questions here live, actually, so you can send those in now. Two different ways. You can send it via email, asktom@talkmoneywithtom.com, or you can send it in to chat if you want to sign into the channel here. We can try to answer those live. We get questions during the week we're going to talk about, with the clients during our strategy sessions. And then, of course, you can send in these questions anytime during the week. We'd be happy to answer them. So feel free to start sending them in. Of course, we created this channel because we felt like there was a shortage of knowledge in these areas of dealing with retirement planning specifically. And so you can feel free to peruse the different videos, subscribe to the channel, hit the bell button, and when we put out new content, you can get notified. And of course, you can always meet with us too if you'd like, whether you're a client or not. Half an hour. We don't charge for that, just an initial consultation, a free consultation. You can do that by booking an appointment right on our website for our business. There's a link to that. You can go up in the corner, you'll see a button looks just like that. And schedule a time, and we'll be happy to talk to you, phone, video, in person, whatever works for you. So look forward to it. All right, so I do like to start off the week, every week of the show with a summary of kind of what we saw happening in the stock market this past week. And I'm going to put up a chart that's a little bit different than what we normally look at. So we look at the S&P 500 data, but we mostly look at the weekly data. This is the monthly data. It just allows me to go back further in time so we can kind of talk about more of the macro pieces that are going on. I think, it's nice to do a summary for each week, but once in a while it's good to step back and just take a look at the whole picture and see where things are. And so if you look at this is a pretty interesting time frame because, first of all, if we go here to this first, piece here, this was the greatest 5 years in the history of the stock market, 95 to 2000. Mm-hmm. We call it the dot-com bubble. But it's a little, I don't know, it's almost derogatory to call it a bubble. It was a fantastic time frame to be invested. And even though it did drop 45%, it had gained so much prior to that. If you were in for most of that, you still did quite well. Mm-hmm. And so, that movement, in my opinion, is closer to what we're dealing with now, just because that had to do with a kind of a revolutionary change around the distribution of the internet so people could get to things. And we could have shows like this streaming live that wasn't available prior to that. This motion here obviously has a lot to do with what's happening with the artificial intelligence, and so it's the same thing. Now, we're not getting the same type of explosive growth that we got in that 5-year period because there's a lot more headwinds here than we had back then, mm-hmm. in my opinion. So we'll talk about that as things go. Of course, that led to, essentially an overpricing. Everything got completely out of control in terms of pricing. The NASDAQ went up 100% in 1998, and then we ended up with a 45% drop in the stock market. I call it sort of like a tulip mania drop. It was just way overpriced. The PE ratio actually got up to 45 at one point in time, and that was considered one of the most expensive markets. Well, almost every measure I've ever seen, that's the most expensive market in history, maybe competing with where we are now. We're at 1 and 2 right now, depending on what you look at and what measures you look at. So you can overstretch, and when you do, you're going to have that bounce back to the downside. Still fairly healthy time frame, in terms of what happened after. But what was weird is that we recovered quite nicely, and we recovered essentially on a refinancing boom and a housing purchase boom. And what had happened is that the banks, essentially put these loans, these bonds together, filled with mortgage loans, and resold those, which then gave them capital to go out and get more mortgage loans, and they were making money on these transactions. And so they were starting to give loans to almost anybody because it didn't matter. They were selling them off anyway as one portion of this one bond. And unfortunately, these big companies started to sell insurance policies on top of these bonds. and the stock market ended up falling apart, and we had a financial disaster, which tends to be worse than a normal tulip mania type disaster. And market dropped 57%, highlighted by Lehman Brothers failing. And so those are the things that are in the background. That's kind of what's out there. But look at this so far. I mean, technically, this is not a continuous bull market run, because every time the market drops 20% or more, that stops the previous bull market. So theoretically, the pandemic dropping 35% dropped the bull market, and we started over again. Ran until 2022, where we dropped 28% from high to low, right? But if you look at this trend, what's interesting to me, if you take out those two, big motions down and up for the pandemic, and they're related, one, everything's shutting down, market's going to freak out and fall 35%. The second one is everything's reopening without all the people coming back to work yet, and you end up with an inflationary spike, right? You take that out, we've been on a continuous run all the way since 2009, right? And so the thing that changed in 2009 was this concept of the bailout. And we've done that, with TARP and TARF and all of these different bailouts that happened during the pandemic, and money that came out in these PPP loans, right, and all these different things that were out there. And so that has fueled this, along with the fact that the Federal Reserve started experimenting with what's called quantitative easing, where they're literally buying bonds off of the market in a way to basically bring cash flow into the economy itself. That's somewhat controversial how that works, but nonetheless, that was happening during that period of time. And so I think the one thing we have to keep in mind here is, there is a kind of mega trend here that is very strong and continuing to move upward at a really strong rate, and it's not just going to disappear that easily. And so, because the question that I got the most often this week from clients is, why is the stock market doing so well in the face of all of these different problems? And so for the average person that I have as a client, they look at things like Venezuela and they look at it as this really, dramatic event, and the stock market's totally ignoring it, and they don't understand why. And so I remember during the George Floyd riots, the market was going up during January 6th, invasion of the Capitol, market went up on January 6th, market went up on January 7th. So again, it has to be something that impacts the economy. And when you've got relatively low interest rates, which we still have now, we're back down to 3.25%, 3.5% on the Fed funds rate. And so, and combined with this, overall growth of this technology business and what's happening with artificial intelligence and such too. So I think what's happening right now on a shorter term basis, and the analogy I've been trying to use with the clients is, imagine you're in a boat, a yacht of some type, it's in a harbor, you're floating along on the water, but the reef isn't that far below, but you're fine because you're above the reef with the water. And I look at the water as like the good things that are coming into the market. And the two big ones, of course, are the artificial intelligence spend on data centers, no doubt. That's a huge piece of driving the economy. It's kind of what's keeping that tide up above that, up above the rocks. And then the second thing, of course, is lowering of interest rates, which we did some last year. We've been going back and forth with how many are being bet on this year, but right now it's around 2 more interest rates cuts. And so those two things are the water. They're what's kind of keeping your boat above the rocks. Now, there's rocks, and they're adding to the rocks, and they're making the rocks even higher. And so, but it's still not high enough to overcome the good parts that are floating above those. So some of the rocks that are down there are, the tariffs and the possible of increasing tariffs even more come July when they take a look at the Canada, U.S., Mexico treaties that are out there that are currently getting a whole lot of products with no tariffs that might start to become tariffs, right? You've got, these situations with the independence of the Federal Reserve where the DOJ is sending out subpoenas based on, what looks like political pressure. And whether it is or not, it looks like it, and it does make the markets around the world question, the independence of our Fed, right? That's just kind of adding to those rocks. We had a suggestion, which seems like a good idea on the face of it, which is, to enhance affordability, let's cut interest rates on credit cards down to 10%, right? So right now you see rates in that 25 to 35% rate, on some people, right? If you cap it at 10%, basically the banks won't lend to anybody who they aren't sure can pay them back, which seems like a good idea, except for the fact that that excess credit card spending right now is helping keep your boat above the
Yeah,
rocks,
keep you everyone afloat.
right? It's kind of pushing that through. And maybe we should have less credit card spending. But if you do that right now, and they're doing that to try to make the midterms work out better, I think it makes the midterms work out worse because they're going to cut credit for a lot of people that are using credit right now.
Yeah, people they're going to tighten credit if there's less profits to be made.
Yeah, do that over a 5-year period so everybody can kind of wind down, the economy can kind of adjust into it, and we go from a cap at 35 to 34 to, whatever, just keep moving it down. And, that would work. Of course, it doesn't help you in the midterms. But what it does by putting that 10% in there, and hopefully it's not going to happen. I think that would be an economic draw. It would bring those rocks up really close to the bottom of the boat. And you start to put enough bad things in there, you could overwhelm this kind of upward motion. But it's going to take a lot. I mean, we've had a lot, and we still are going.
Yeah, especially if the tide goes out, too. That
Right.
could be another thing that...
Well, that's what you have to watch for. You have to, if they stop cutting rates, if they stop spending money or as much money on artificial intelligence data center build-outs, that's going to lower the water level. The tide's going to go out. You could hit those rocks because of that. You could hit those rocks because they keep building up the rocks underneath, if that makes sense. And so at the moment, the tide is in, the boats are floating fine, the rocks are well below the water line. The good stuff that's happening is enough to kind of drive things. There's lots of warning signals, but there always is. Matter of fact, there was all the way through this time. This is 2009 to 2026 now. I mean, that's a long period of time of, relative success in the stock market. That's not disappearing. There's too many people out there that are buying the dip. They don't really understand the full ramifications of what can happen in a real dip, but that's okay. They just keep coming in with their money. And now using, different platforms that allow you to buy options, you can actually have a bigger impact on some of these stocks with smaller dollar amounts by buying options. And those people aren't going away. Now, some point in time, maybe everything goes away, sort of like it did in 2000, just because things get so crazy. And then the downside gets high enough that the dip buyers can't come in and save it, type of thing. But we're probably a little ways away from that. I think with the momentum we have now, we're okay for the next 3 to 12 months. However, the problem is that right now we're in this very fluid environment where we don't know what's going to have an impact. What impact happens if there is a Greenland situation where we try to take over Greenland? What if there's a military action with Europe, who's now sent, usually that type of thing is not that big of a deal to the market because of the, there's not a lot of identified economic impact from that, but it doesn't mean there wouldn't be one. So, you just keep adding on pieces, what happens with Cuba, what happens with, all of these different components that are out there in terms of affecting the economy, and what could make those rocks build up so high that the tide, even though it's in, isn't high enough, I think that artificial intelligence, just to finish on that, I think the spending continues there with just a couple caveats. And one of the reasons I say that is because these companies that are spending this money, for the most part, are big companies that have the money, that have the cash flow, they have the cash on hand, they have the ability to borrow at low rates if they need to, right? I think the one thing that could slow things down could be the investors in these companies looking at it and saying, look, you're taking this huge risk, right, with all of this money without a known outcome, right, which is not unusual, but it's going to start to demand some type of thought process on what that outcome might be, instead of just saying, hey, we're spending, $100 billion, $300 billion on these data center build-outs. We saw Oracle get hit pretty hard with that. And does Oracle change its pattern a little bit because of that? Do other companies start to change their pattern on what they're spending? Does it slow down some just because they want to make sure they don't have a 40% stock drop like Oracle did? I read a really interesting article about Apple kind of just sitting on the sidelines with AI, somewhat could work out to their advantage just because they'll be able to come in and to take whatever, instead of investing all this money up front on an unknown, they can come in later and kind of buy companies that already have something that's working
Yeah, and there's
incorporate it
also
into their platform.
Michael Burry had a prediction about saying that eventually they're thinking that it will just become cheaper and cheaper because the technology just becomes better and better, and it'll be,
Yeah.
and so they will need less investment because everything will be just more efficient.
Oh, yeah, yeah. Well, that makes sense, right? I mean, over a period of time, it should be a, there's still a big race to this to this conclusion. So anyway, that's what's happening this week. Interesting time frame to be in the stock market. We've got lots of little things going on. We've been trying to break through to a new all-time high on kind of a daily basis since the end of October. We keep doing it and then falling back down, and we fall back down into the range. It's not super strong, right? I mean, it's strong. The range, it's going through the top of the range more often than the bottom, but it's not getting that big blow off top. I think there's enough headwinds and enough issues there to kind of create some friction for the market right at the moment. I don't know that it's enough to create a big downturn or that we're having a big topping action. I think we just don't have that catalyst. So we're also very close to 7,000 on the S&P, and that I thought we'd get through that last year by the end of the year, but it might be having more impact than thought, just in terms of people kind of selling as it gets close to that. And
Yeah, it's a
maybe
very psychological number.
it is, and maybe we break through after that, right? We get through 7,000 because we usually have a decent breakthrough when we get through a new all-time high. We haven't been having that since the end of October, so that's a little bit unusual. We'll see how that plays out. But anyway, look forward to next week. We can talk about what's happening then, but we'll get into our questions now. What do we have for a question?
So, what is market breadth, and why is it important?
Okay, so one of the things that's starting to come up, specifically this year for the most part, even last year to a little bit, we've had this narrowness in the market for quite a while with the Magnificent Seven and these big tech companies kind of really driving the stock market. Because they're big, they have more impact on the indexes that use market capitalization as a weighting method. So the S&P 500, of course, is one of those. The NASDAQ is another one. So, we're starting to see, I don't know, if you look at the equal weight S&P 500, it's doing okay, but nothing, spectacular. What we are starting to see is more of a move towards the small caps. Mm-hmm. So I think it's 11 days in a row right now that the small caps have outperformed the large cap indexes. Now, we've had so many false moves to small caps. It's unbelievable over the years. But one thing that has happened with this particular move is we've kind of come out of a long-term range, and we're starting to kind of break out of that range, which could be fantastic.
Yeah, because the Russell 2000, which is a pretty good indicator of the small cap stocks, is up 20% in the last 6 months versus around 10 or 11% for the S&P 500.
Yeah, and the reason that that's important is because what it usually demonstrates is sort of a shift into the risk area. And it just shows a market that feels confident about the economy. And so when you start to see small caps take off, it's because of this confidence. Usually we've already kind of tapped out the larger caps. I mean, those have been running since 2022, really. I mean, almost exclusively we've had, very little participation from the small caps. And so there's this whip around action where the money starts to kind of rotate out of those big names. And we saw this in the dot-com motion, right? At the beginning, it was the big companies. It was Sun and all these things. And then all of a sudden, it started to become the smaller companies. And then we started to see an IPO market pick up, which we haven't seen yet. So those are pieces of the pattern that I'm actually looking for to see what's going on. So the importance of this motion to small cap and increasing the breadth of the market, and so more companies are getting money is what more breadth means, instead of just fewer companies, I think is super important. I think it demonstrates kind of the directionality of the market. We're in an environment where almost anything can happen, so it's a little bit hard to say, oh, this is it, we're really going to go, because tomorrow we could have problems with China and Taiwan, or who knows what could happen, right? So we're at a little bit of a heightened level of uncertainty. However, we are seeing this motion into small cap, to me, which shows a confidence, right? And I think that's really important. It's a sign when you see small caps right now. 11 days in a row above is great. Beating, in the last 6 months is great. But we've had a few times like this in the last several years.
There's a bit of sustained
It
trend.
just won't get past that. It hasn't, and it breaks down, right? I get a gut feel that this is not the time it's going to break down, because this is the time within a normal run where you would start to see a rotation towards something more aggressive like small caps in this particular area. So I think this could be something worth watching. It could be a time finally where this does start to outperform. So that's what's important about the breadth. I think it's important as a signal overall. It's important to watch your exposure to those asset classes to make sure you have something there to capture that motion. All right, what's our next question?
So, what's the difference between a health savings account and a flexible savings account? They're both kind of tax qualified accounts for medical expenses that are quite advantage, where you can use pre-tax monies for qualified medical expenses.
Yeah, we've got a little chart here, a couple little charts. So HSAs, you own it as the employee, versus the FSA is set up by the employer,
Yeah.
right? The flexible spending account. And so you have to be in a high deductible plan on the HSA. So that's one thing that's quite different, right? You might have to pay the first $5,000 of expenses every year yourself if
Yeah.
you've got that as a deductible.
Versus the FSA, where a majority of it is most group health insurance plans for larger companies will have FSA or flex spending accounts for you. The thing is, with them, employers can contribute to both, and employees can, and it's kind of, you defer kind of like your taxable income to these accounts, and then you can use it for qualified. The major difference is with an HSA, you can kind of keep it rolling it over, while FSA is a use it or lose it kind of thing. So if you don't use all of it in a certain year, you only have a portion that you can carry over. Some companies usually have up to a 2.5 month grace period where you can still kind of try and use it, but if you don't use it, it gets returned to the employer.
Yeah, so that's the biggest difference, in my opinion. The HSA, you can just build up money, and we're seeing more and more clients deciding to not use it until retirement. So maybe they go into retirement with $100,000 or $200,000 that they can use towards medical expenses. That's growing tax-free as long as they use it towards medical expenses. Yeah. And so that's kind of a neat thing. Now, both of them work the same if you're going to put money in and then spend it all. So I put in $3,000 and I claimed $3,000. They're both the same. There is no carry forward anyway. The FSA, you kind of have to do that.
Yeah.
And the advantage, of course, is that you're putting that $3,000 in before taxes. So if normally you would lose, say, $1,000 to taxes, now you're getting to keep that $1,000. You can spend it on health care, and basically the government's paying that $1,000 that you would normally pay as a tax. So both of them have that piece, but with the HSA, you're able to let that $3,000 maybe grow to $4,000 or
you could
$5,000
defer
or $6,000.
you can defer. You could say, hey, I'm just going to pay out of pocket. I'm just going to let this grow.
Yeah, and that's why I say, there's an investment capability down here under the HSA at the bottom. Just means that you can go out. Fidelity has a really nice HSA program. You can buy indexes. You can do all kinds of things. That's what's really changed there, because originally HSAs were just kind of a fixed earning account, paid some interest, which was okay. But the FSA, because there's no real growth past each year, it use it or lose it. So they've got, here's the health savings accounts, like contribution limits, right, for what's going to come in. But this particular chart here shows kind of max contribution you can make, and then how much you can carry over. So if you, in 2026, if you put in $3,400, you got to spend it down below $6,800, right? And again, some companies will give you a leeway. So, but if you don't have that, it actually reverts back to the company. So if you leave $3,000 in there, the differential reverts back to the company. So that's the biggest difference between those two. They're both worth doing. You just have to handle them differently.
Yeah, a lot of the new healthcare proposals have talked about using HSAs and FSAs as kind of ways to subsidize health insurance and stuff like that. So it'll be interesting to see how these accounts change or evolve.
Yeah, because the problem with the HSA is that the difference there is you have to have that high deductible. So you might have a $5,000 deductible. So the first $5,000 of your expenses every year you're going to pay. Now, maybe you don't go to the doctor very often and you never get to 5,000, but,
Yeah.
but if you do, then essentially every year you're paying out of pocket 5,000, and it's probably not enough to write off in terms of a medical expense. So it's
Yeah.
just out of pocket. And for that, you're getting to save taxes and make that HSA grow. But every year you're paying out potentially 5,000, so you kind of need to calculate that.
It is definitely a big calculation.
Yeah, versus the FSA, you're putting the money in and using it. You just have to be fairly accurate about what you might need that year.
Yeah, and so what I've heard for FSAs is always try and go on, if you have like a range, let's say I expect I'll spend $1,000 to $2,000. It's always been said to go for the lower end
Yeah.
plus whatever your carryover is. So let's say your estimate is $1,000 and you know the carryover is $680. So they would suggest that you put in $1,680
Yeah.
into that FSA.
That makes sense. Yeah, that way you're fairly certain of being able to use that up.
Yeah.
And if you have to go into your carryover, that's fine too, right?
Yeah, and you
So-
can always increase your deferment later on too. You don't have to do it.
Yeah. Yeah, it's a good question. It's an interesting area. It's, coming into the planning aspect of retirement, that's where the HSA is coming up more and more as a thing that people are starting to build up, $100,000, $200,000 in these things. But you got to do the calculations on what it's costing you on that
And
deductible.
I think with FSA too is you can elect a number at the beginning of the year, and then you can actually go negative in theory. So because your contributions will make up it over the entire year for that employer.
Oh, yeah, that makes sense.
So with FSA, when you leave a job and you have an FSA account, you might want to just double check with what goes on with that.
Yeah, yep. All right.
So what is imputation, and how does it affect CPI?
So imputation, we would call imputation sort of a guess.
Educated guess.
Educated guess. There's several articles out there saying imputation is not a guess. So what it is essentially we have a set of data. Specifically, we'll talk about the CPI, the Consumer Price Index. We have a set of data. We don't have all the hard data that we need, and so we impute from the existing data that we do have what the overall answer would be.
So it could be
essentially.
like you, for the surveys, you have a loaf of bread and you always use whole wheat loaf of bread. But let's say the one that you always sample is out of stock at this one store that you always sample from. So maybe you go to the store down the road and then you use that. But that store may sell this bread slightly more expensive. Kind of like if you go to a higher end grocery store versus a lower end grocery store, they may have the same products, but they have different prices.
Yeah, exactly. And so the reason that's coming up is because we're seeing, here's the last CPI that came out this week, right? So they're
Yeah.
saying it's 2.7%, 2.4% growth on food, 2.3 on energy, and 2.6 on everything else besides food and energy,
Mhm.
right? And the problem is we've got, last summer we fired the head of the BLS, the Bureau of Labor Statistics, who produces the numbers for the CPI, for the jobs numbers that come out, the unemployment numbers and all those things. And so what's happening is we're seeing reporting of higher and higher imputed numbers coming into the fold for things like CPI.
Yeah, December's report or the December release of November's data had an all-time high of 40%.
Yeah,
I think they're allowed to go up to 50% for the data.
right.
And so there has been a skew, and it could just be, there has been budget constraints and operation constraints to the BLS, and so with less people, you can do less essentially. And so some people are saying that they're using this to kind of compensate for that budget constraint.
Yeah, which is fine if it's accurate, but now we're wondering, right? Because we got this great GDP number at the end of the year, and is that really accurate or not? Some of the numbers don't seem to be matching up with some of the things we're seeing, in other areas of more private data collection. And the matter of fact, the Federal Reserve flat out came out and said that they're underreporting they're overreporting the job growth by 60,000 jobs a month. So that was at the last, the December meeting.
Mm-hmm.
And so, you got these situations where the Federal Reserve is notifying us as investors that some of the numbers might not be as accurate. So that's what that's where this is coming about. They're talking more and more about imputing. You know, it was fairly low at the beginning of the year, and it just continued to tick up, and especially continued to tick up in terms of percentage of the overall numbers after, you know, this lady was fired at the head of the Bureau of Labor Statistics. So, you know, we're going to have to find some of these numbers on our own in different places to make sure that what we're seeing is, you know, accurate as far as that goes. The market is still moving on these numbers, so, you know, we'll see how that works out.
Yeah, I think the numbers really affect how the Fed makes their decision, and I think that's what the market is keying off of. If the Fed is getting data that's accurate, and then they're using this data to determine whether to cut rates or, you know, increase rates, whatever they just make their evaluation of the economy.
Well, that's why I thought that December comment from Chairman Powell was so dramatic. I've never heard of anything like that. I've never heard one single time in all the times I've watched for 30 plus years these Fed governors get up and talk. I've never heard one say, "Oh, the government is, you know, mistaking, especially the wrong direction. They're adding 60,000 jobs." I've never heard that before. So that's where, you know, I think there's a signal there that the Fed is worried, which is fine. The Fed isn't going to do anything based on those numbers. They're going to have some of their own backdrop numbers to look at and whatnot too. As long as the Fed's aware that the numbers are, you know, need to be further scrutinized, and that's where this imputation comes in. And so there's some concerns that is growing to be a bigger piece of it, in the middle of all these other concerns that we have about the you know, how these numbers are they accurate or not. Yeah. So it's a good question.
So, why is silver going up so much, and what's keeping it going?
Okay, so I have a chart here. It's kind of crazy. So this is the iShares Silver Trust. So it started in 2007. So this is the entire track record for this particular ETF. Ticker symbol is SLV. I have the monthly data up here just so you can see, you know, the long term. There was a big run up from '09 to 2011. You can see there at the beginning. And then we spent like 14 years going sideways, right, with essentially no real gains out of silver. And now we're taking off. And so why is it taking off? Well, kind of a confluence of things. Silver is the most electrical conductive metal in this category, and so it's become in demand for data center build-outs, right?
Yeah, solar, electric cars, any kind of electronics.
Yeah, solar panels, electric cars, yeah, all the electronics pieces and what have you. And so you've got this situation where the industrial need has grown pretty dramatically. And when you read into it, the need for silver has outstripped the mining capabilities for silver for the last 5 years in a row.
Yeah, and one of the reasons for that is that silver is not usually, you don't usually mine silver solely. 70% of silver comes as a byproduct of other metals.
Other metal mining, yeah.
And so they usually come from gold, copper, lead, zinc as a byproduct.
Yeah.
And so it's hard to ramp for a byproduct.
Yeah, that's right.
It's not easy. They're saying that many of the established mines are having also lower grade silver now for ore. It takes time to set up mines. They're not quick.
Yeah, that's what you get. That's how you get a shortage. That's how you get a spike. Now, the interesting thing about this is that China controls 70% of the world's export of silver, right? They also are the #1 user of silver because they've got some really big investments into solar and EV and data centers and such too. So you've got this scenario now as of January 1st where they are actually, it looks like they're restricting the export of silver. Everybody has to register and basically apply to be able to export it outside the country. Mainly because I think it's not just political, it's not just for tariffs, although I do think that factors in. It has more to do with the fact that they need it. I mean, they're the largest, country that needs the metal, and so they have the metal. If they give it all away, they don't have it for their own industrial production. So I think they're trying to protect that. Of course, that just makes it go up even more. The last piece that's there is just, it's seen as a safe haven metal, like gold does, Yeah,
you can see it spike in the '08 to 2011, right?
That's right.
As people run to something they feel physical as safety.
Right. They want, the dollar has actually stabilized some recently, but certainly is down over the last, 12, 18 months. And you've got the situation where, people are coming out of the currencies like that and buying, gold and silver. And silver's just had this great run. It has more industrial needs and more shortfall between industrial needs and the mining, production than you see in gold. And gold's still the gold standard, so to speak,
Yeah.
in terms of that safety arena. But silver has become, the hot commodity. It's up tremendously. Just, I think we bought it in October. It's up like 80%,
Yeah.
since then. And here's the issue: is more of like, what do you do now? Okay, so it's up this far. Do you dollar cost average out? Do you rebalance the portfolio? I think the basics for what's happening for the shortage, there are solutions to those shortages, but they don't happen very quickly. So, for example, silver gets very expensive. They'll find other ways of kind of creating connectivity with other metals, likely, right? Just because the silver is so hard to get or so expensive. So there's going to be probably some demand destruction that happens when you get up to a certain price. Alternatives start to become, whatever that might be, some other metals start to become useful. Does it change, geopolitically? Is that going to change anytime soon? No, I don't think so. Not in the next, let's talk short term, 3 to 12 months. Does the geopolitical situation get better in that time frame or stay the same or worse? I say same or worse, right?
Yeah.
So that means there's a drive towards silver for that. Does the need for, silver stay the same or get higher based on what we're seeing with EVs? They're softening, but solar panels are still okay, and certainly the data centers.
Yeah, data centers are
right?
growing.
So I think that demand stays there for the next 12 months, barring, hiccups with these earning reports. Let's see what happens.
Yeah.
But I still think it stays there. And then you have, you have this situation where China is restricting, the outflow of the metal. I don't see that changing either. So I think this little run is here to stay for a little bit. However, silver can turn around and be a negative 40 next week. I mean, it's that type of metal. If you look back in its history, it's basically not. I mean, if you look, those are peaks, not plateaus. There's a couple plateaus in there, but if you look at the real big runs, they didn't stay there for very long.
Yeah, and you can use the example of uranium. A few years ago, uranium was jumping off the charts and had pretty much a crash afterwards.
Yeah, it probably doesn't have the same industrial need, as this does. This has got a robust need, and I really like that. But I would certainly be dollar cost averaging out of this or into this, depending on which direction you're trying to go. If you have a holding already, be careful it doesn't take over your portfolio.
Yeah.
I like to let winners run, but that chart's pretty crazy. It's monthly data, so it's taken out some of the ups and downs, but
That's a pretty stark list.
yeah, it'd be hard to buy it here, personally, although I still think it could go higher, but it's still difficult.
Yeah, and you also want to think about your capital gains too, depending
Yes.
on where you actually hold the silver, what is the gains, and like what is the cost of it, short term, long term.
Yeah, this is the challenge we have as investing advisors is just, okay, so we have silver, let's say in an IRA or Roth or whatever. We don't have any consequences. We can sell half of it, get back down to our original allocation, because it's nearly doubled. That's not an issue. But for those accounts that are outside of IRAs where it's a taxable transaction, we just bought that in October. So whatever we take as profits now is going to be taxed at ordinary income. And so that's significantly higher. For most people, it's in that 22%, 24% range. For some people, it's in the 32% range versus capital gains are likely going to be 15% on the federal basis. So if you can keep it for a year, you can get that lower capital gains rate. But it's a tough one, right? And that's probably why I would dollar cost average and rebalance like the IRA type assets at this point in time and keep the trust type assets, the taxable assets, try to keep them for a year. If things start to really fall apart, you probably want to protect your tax, your gains and pay the tax anyway, because you can wipe out your gains. And then, great, you don't have any tax, but you're better off.
Taking the tax.
Yeah, you're better off paying 22% or 32% than losing all of it.
Yeah.
That's what happens.
You rather get 80 cents back than zero.
That's right. So anyway, that's a good question. I think it's a really interesting area right now, is this area of the metals. It's, to me, it shows the uncertainty. We're seeing, a breadth coming through with small caps, which shows me confidence in the market. But at the same time, you're seeing this run up in precious metals that are often seen as safe haven asset places. So worldwide, I think there's an interest in hey, this is kind of a scary time frame. Doesn't mean that it'll transpire to be something bad, but it is something kind of contrary to that small cap run that we're seeing. So we're seeing both. It's kind of fascinating to see who's going to be right. All right. Do we have time for one short one?
Sure. What order should I distribute funds for my daily living expenses and retirements? I only have a small taxable account around 30,000, but I have a larger IRA around 500,000. I know it's tax efficient to take from a taxable account first versus an IRA, but my taxable account is so small.
Yeah. So I think the rule of thumb is you take a look at your assets and you want to withdraw from the place that you have the least tax and the least return.
Mm-hmm.
Okay. So if you rank all of your stuff, probably the money in your checking account would be at the top, because it's not, if you take money out, it doesn't cost you much in taxes at all, if anything. And then, of course, it doesn't grow much, so you're not losing much in potential growth long term. However, the big caveat there, when you line up all of your assets in terms of, least return at the top and least, a tax at the top, you'll find that sometimes the money need, there's a psychological aspect of it that precedes the analytical piece. So if I spend down all of my available money, like in this case, we have 30,000 outside of the IRA, and let's just say that's all they have, just ignoring whatever else they might have. That's their buffer, because that's easier to get to. It's not as taxable. Technically, you should be spending that first. But the caveat I would have is you spend down those assets until they get to a level where you don't want to spend them down anymore.
You want that buffer.
You want that buffer. Now, everybody's got a different buffer. People have $500,000 that they want to have on hand in liquid type assets so they can handle some big expenses really quickly without having to worry about, paying a huge amount of tax and what have you. So in this particular case, with just $30,000 in a taxable account and $500,000 in IRA, you would want to start withdrawing from the IRA for income needs and preserve the $30,000. For most people, some people think 30 is more than enough and they want to actually draw that down lower, but most people think 30 is actually not enough.
Yeah, especially when it's a recurring, kind of daily expense. So if it's a more monthly, because what if you need to replace the roof or you need a new car? It becomes very tax expensive to take the money out from the IRA versus, this kind of taxable account, because you're only taxed on the gains rather than the actual, while an IRA is, you're just taxed on all of it.
Yeah, so a good example would be the roof. Let's say the roof costs $20,000. So I go to my IRA, I want to get $20,000. I might have to pull nearly $30,000 out to get that 20, and the other 10 goes to taxes. It makes it a $30,000 roof, at least for this point.
Yeah.
Versus, hey, I've got this $30,000 sitting in my taxable account. I can pull 20 out of that. I only have to pay taxes on whatever gains that I have. So it kind of depends. And it could be that you could get 20 out without any gains, depending on your history with that particular account. And so that's the better place to go get. Now that $20,000 roof might only cost 21 or 22,000 because the taxes are a lot less. And so that's why you'd want to keep that money out there for that type of lump sum situation.
Yeah.
In my opinion. So that in that particular case, you'd normally, let's say there was 300,000 or something in that taxable account, you might want to start your income needs there, because that opens up a whole door for you if you wanted to do Roth conversions, right? You can have almost no income for a while. You could run that down to say 100,000, say, okay, that's where I stop, because I'm going to keep at least 100 on hand, but I'm going to use this other 2 to live off of for a while. reduce my taxes dramatically and either just enjoy that or use that time frame to start doing some conversions or, other
Yeah.
strategies I might be able to do in that window. But when we only have 30,000 in that type of an account, probably we want to just leave that alone and start drawing your income out of your
And you
IRA.
may also want to look at your tax situation too.
Yeah.
Are you in that period prior to Social Security and, taking money from your IRA, you may want to take some of it just to get your cheap tax rates,
Yeah.
still in that 10 and 12% tax bracket, because you can't go back and fill those brackets in the
Yeah,
for
that's a good
past
point.
years. So
Yeah.
you may want to think about filling those brackets.
Yeah, exactly. Even if you have almost tax-free money sitting in your taxable account, it still makes some sense to at least get, it depends on your situation, but if you can get some of that money out of your IRA at 10 or 12% and hit those bottom levels because you've just retired and don't have other income, and you're not 73 yet, you're maybe not getting Social Security yet, so you really are in that window where you might be able to take some money from your IRA just because it makes sense.
Yeah.
You're right, because 2026, if I could have taken some money out at 10 or 12% and I didn't, I can't go back.
Yeah.
So it's a one time I could get money out of there. And so those are weird scenarios, but they do come up. We have lots of situations we've dealt with over the years where we had situations like that where we can try to sneak money out at the lowest taxes.
Yeah, trying to be a little more tax efficient.
Yeah, tax is a big deal in retirement. It's a big expense altogether. It's really important to try to figure out how to lower it. So, okay, well, that's our show for today. Really look forward to being able to see you again next week. And again, send in questions now during the week if you want. We'll be here next Friday. We can answer those. You can email them and ask Tom at talkmoneywithtom.com. Go ahead and subscribe to our channel. Hit the bell if you want to get notified of new things coming in. And if you really want to, please come and meet with us one way or another, client or non-client. We're happy to spend 30 minutes talking to you about whatever questions you have. We have a book appointment button on our schedule on our webpage. Looks just like that. And go ahead and set up a 30-minute time to meet with Ethan and I. So look forward to seeing you again next Friday. Thank you very much for coming.